Futures up again after the big rally yesterday. 30 minutes till the start of cash trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, investors trying to keep Fed rate cut bets alive. Investors are digesting a fresh batch of retail data that still signals a strong consumer.
And the beat goes on. Bank America and Morgan Stanley add to Wall Street wins while HSBC strikes out, cutting bonuses.
And it's not just banks. We'll cover all of the other big earnings, movers, that is, including United Health's revenue miss. All of that and more coming up. Let's take a look at these markets. Of course, like Matt said, slight gains on this screen behind me. Not quite the big rally that we saw yesterday after that CPI miss, but we got retail sales about half an hour ago coming in a little bit lighter than expected. That's giving a little bit of a lift to the big indexes right now. The S&P 500 up about 0.1%. Big tech doing a little bit better. The NASDAQ 100 higher by about 0.4% pre-market. And then you take a look at the bond market. I haven't been here for a few days. I thought we were worried about 5%. Maybe we still are, but we've come down in the past 2 days pretty dramatically. Up a hair this morning, Matt, on that 10-year treasury.
Remember when we were worried about 4.5%? That seems so comfy now. Yesterday, I was lucky enough to anchor the close on Bloomberg Television. It's the second most crucial time of the trading day. And we saw a massive gain for the S&P, 1.8%. This is every single CPI day as measured by moves in the S&P over the last 2 years. And you can see it was the second best reaction. I will be anchoring the close again today, so do tune in between 3 and 5 p.m.
Had no idea. Matt all day. How fun for everybody. Anyways, some stocks we're watching here. Bank of America now down pre-market. Pretty fascinating, down 0.4%. Remember, there was a big rally yesterday. They beat trading expectations in the most recent quarter. Brian Moynihan, the CEO, sees a solid economic environment. He also boosted projections for lending profits. Morgan Stanley still on the rise, 2.3% higher. They also blew past estimates when it came to trading revenue. And of course, we are watching those investment banks just flying this year. However, we don't have all good news across the board in terms of earnings. United Health Group now down 4.3% pre-market. Medical costs came in more than Wall Street expected here. Fourth quarter revenue also missed expectations. The company is reeling, remember, from the murder of a top executive last month, Matt.
All right, so a lot to talk about in terms of really bank earnings are front and center, but also Scott Bessent is going to go in front of a Senate panel today looking to be confirmed as Treasury Secretary. He is going to say he supports a strong dollar policy, which every Treasury Secretary has said since Bill Clinton.
He didn't go that far, Matt. Of course, we're torturing the English language a little bit here. He said that he was talking about the U.S. Treasury's reserve current, or the U.S. dollar, the reserve currency status of the dollar. He didn't go as far as saying he explicitly supports the strong dollar policy.
That is actually interesting, because the only Treasury Secretary that's really deviated from a strong dollar position was Steve Mnuchin, and he only did it for a brief moment, but it caused a little bit of turbulence in 2018. So
absolutely, and we know Trump himself would probably like a little bit of a weaker dollar. The dollar's just been going straight up, it feels like, since October.
Now, what I wonder is if you're going to have congressional representatives here asking him about issuance and the schedule here, because that's something that, of course, he has
You want them to get deep in it, huh?
I do. I like watching hearings. I'm one of those strange ones.
Might be disappointed. I think we're going to get a lot of sound bites.
I don't know that many politicians know as much about financial markets as you do, so I don't see them really going there.
Financial markets have been in their ear.
Yes, for sure. And we have someone, fortunately, with us who knows a lot about it. BNY Wealth Chief Investment Officer Sinead Colton Grant joins us now on the desk. Sonali's worried about issuance, and we'll see that unfold over 2025. What do you think about the level where we see treasuries right now? I mean, I thought 450 was the danger zone, and then everyone was pretty cool about it until we got closer to 5.
Well, look, we should get used to more volatility in fixed income. That is definitely back. But it feels like we're back in the 90s when Treasury yields were around these levels. Equity markets did pretty well, and, you know, bond markets also did pretty well. But the thing that comes with that kind of volatility is really opportunity. If you're an active fixed income manager, this is a great environment for you. And when we think about inflation, which is clearly one of the drivers of what's happening with yields, we had a better print yesterday, it caused yields to come down. We're probably going to hear more about the level of outstanding government debt today in the Bessent hearings. That's another driver. But look, in the high fours on treasuries, we think this looks pretty attractive.
Let's talk about what that means for the stock market. I'm curious where we are in the 90s, whether we're in the late 90s, because if you take a look at 2000 to 2010 for the S&P 500, it actually fell about 7% on a total return basis. And that sounds scary to me.
Well, and remember what happened at the very start of that decade, which was the tech bubble bursting, right? The dot-com bubble bursting. The two things that drive stock markets, they're earnings and interest rates. Interest rates have been moving lower, and earnings, we think, are going to continue to expand 10 to 15% this year. That gives us a great base. We actually think on the higher end, the S&P can move up to about 6,600 for the full year.
What's going to be driving that? A lot of people are talking about sectors. We are starting earnings season. I know that, Matt, you believe that is only at the end of the month.
No, I mean, bank earnings this week for sure, but earnings season doesn't really kick off in earnest until week after next when we get serious size, right?
Here's my case for why it has very much kicked off. If you have investors looking for a broadening trade, are there clues to be picked up with what we're already seeing right now?
We think there are. Look, we like the tech sector, and we should talk about that, but we also like financials. We see significant tailwinds from what we expect is going to be some reduction in the or a less stringent regulatory environment. We're seeing a lot of pent-up demand for M&A. That's all going to be positive for financials. We also like some of the industrials. Clearly, that's a cyclical play, but you've got the manufacturing sector, where if you do see production coming back domestically as a result of the Trump administration policies, that's going to boost it too. So look, we do expect some broadening, but we still like tech.
Yeah, I mean, what kind of broadening do you expect? We're looking at estimates of 14% or more for total earnings growth on the S&P 500 this year, but people are saying the tech earnings growth is going to slow down maybe to the high teens, and the S&P 493 earnings growth is going to pick up maybe to the mid-teens.
So look, we do expect some broadening, but tech is still going to be the leader. I mean, we're talking about 40% of the index. AI is a productivity step change, and what you're really going to see this year is going to be the show me year, because you are going to have a lot of broader industries that need to make that investment, where they're going to have to adapt or die in terms of AI and the productivity enhancements that it brings. The other thing to bear in mind with tech, often they're referred to as a high duration sector. They're not really, because they've got very significant free cash flow. And when you look at the margin expansion that's happened in the S&P over the last 6 or 8 years, the vast majority has come from the tech sector. So there's still more to come there.
Yeah, great point there on the end, because we've been watching, of course, this rise in yields, and that's where we started the interview. 5% on the Treasury, 10-year Treasury feels a little bit far away at this point. Where does that story still hold, though? What areas of this market needs lower rates at this juncture, and when do you think they're realistically going to see that?
It's a great question. So in terms of Fed rate cuts, we're expecting 50 basis points over the course of the year. So that's probably 25 in Q2 and another 25 in the second half. The area that's crying out for rate cuts is small cap. You've got a lot of non-earners. Even if you're thinking about the debt maturity wall in small cap, that's coming very, very quickly. And if you can refinance debt at, maybe a 6 or a 7 handle, that's better, surely, than an 8 or a 9, but it's still not that much relief. So I would say it's small cap. We're not quite on the, we think it's a little early for small cap.
Really interesting to hear you say that. And it feels like there's two elements needed to really see this big comeback into the small caps. There's the interest rate picture, and there's also, of course, the earnings picture. We heard a lot of bullish people about a couple months ago talking about this broadening out that we were going to see specifically in some of those earnings at these smaller companies. Where are you on that narrative?
There's actually a more interesting side to that, because what people often don't do is take a step back and think about what did the index used to look like? How many public companies did you have in the late 90s? You had about 8,000. Now you've got 3,500. So small cap today isn't the same as small cap that we had in the 90s or even the 2000s. And so that's another reason why you're seeing headwinds, because the companies that can choose to stay private are staying private for longer.
Yeah, I was thinking about private markets. That comment really made me want to dive in there. But we have to go right now. Sinead, hopefully we'll have you back and talk more about it. Sinead, Colton Grant there, BNY Wealth Chief Investment Officer. Now, Israeli Prime Minister Benjamin Netanyahu says the ceasefire deal with Hamas is in jeopardy. He's accusing Hamas of reneging on parts of the agreement, but the Israeli cabinet isn't going to meet until it believes Hamas has accepted all parts of the deal. We thought, of course, that was accepted yesterday. I guess signing the deal doesn't really mean you believe all of it is important. Let's talk about it with Bloomberg's Israel Bureau Chief Ethan Bronner in Tel Aviv. Ethan, why would Israel say they don't believe Hamas has accepted every part of the deal when I'm assuming Israel or Hamas has signed the deal?
Look, it's a good question. I mean, it's very difficult for us to know exactly what we're talking about. Early this morning, the Prime Minister said that Hamas suddenly insisted that it got to choose which prisoners were going to be released by Israel, whereas that had not been part of the deal. Part of the problem is that we've seen many versions of this deal, and so I can't tell you what was the original deal and what is the subsequent deal. And I don't really know whether the Prime Minister is making more of this than is necessary. He may be, he may not be. He does have pressure internally as well from two far-right parties that are threatening to bolt the government if this goes through. Today, one of the parties said, okay, we'll give you 6 weeks, the first phase of this deal, but then you must promise to go back to war after that's over. Otherwise, we leave the government. If both those parties leave the government could fall. So there's a lot going on, and it may not only be about Hamas's reneging, although it may also be. My instinct is that there will ultimately they will kind of button this down, and the cabinet will approve it. It may not get started on Sunday as expected, but perhaps Monday, although we just don't know.
Speaking of not knowing a lot of these details right now, Ethan, how much uncertainty does this draw, given that there was a lot of hope that was embedded into the moments leading up to this deal in the first place, now seemingly really thrown into the wind?
Look, it's a great question. I mean, people are desperate to have their loved ones and the hostages home. The people in Gaza are desperate to start a day without a fear of bombs and the possibility of getting together and figuring out what's happened to their homes and so on. Look, it's a huge deal. It's such a huge deal, and there's so much pressure internationally that my instinct is that the deal will begin. But I'm not sure. And yesterday I was fairly sure. This morning it looked much less clear.
Ethan Bronner, reporting from Tel Aviv. We thank you so much for all of your time and for all of your reporting. Now, coming up, we're going to switch. We're going to talk about Wall Street's stellar season because it has been continuing. We're going to bring in RBC's Gerard Cassidy to talk about the bonanza that the banks are bringing in. This is Bloomberg. Time now for the Wall Street Beat. Today is all about the bank earnings. We're looking at Bank of America, Morgan Stanley, U.S. Bancorp, and M&T Bank. A lot of love on that screen. You are seeing intraday Bank of America now up around 2.9%. Morgan Stanley just soaring about 5%. We're going to discuss this with RBC head of U.S. Bank Equity Strategy and Large Cap Bank Analyst Gerard Cassidy. Gerard, you look at the way these banks have come to the surface. It looks like Main Street is doing well. It looks like Wall Street is doing well in a lot of these businesses. I feel like investor focus is going to quickly turn very heavily to capital return. How much do you expect these banks to be giving back this year?
Chanel, you're absolutely right that return of capital is very important in our view. And it's interesting you bring that up because the results so far have been very good. To your point, the stocks are moving higher today. They had a very good day yesterday on strong results from the banks that reported yesterday. More importantly, the outlook for 2025, many of these banks are giving more robust outlooks. But the big news, to your point, is how much return of capital is going to take place this year. And it's uncertain, but that uncertainty has been reduced by the fact that the Basel III endgame, which many of the largest banks are waiting for the final rules here, is going to be much less onerous due to the fact that we've got a new administration coming in and new heads of many of the regulatory agencies, in particular, the recent resignation of the vice chair of safety and soundness at the Fed, Barr. He was the one that was pushing for higher capital levels under Basel III, and now he's no longer there. The vice chair of the FDIC, in a speech last week, indicated that the capital levels should not go up under Basel III. So if this proves to be true by the end of 25, the banks will have plenty of excess capital, and share repurchase programs are going to be very robust in 25 and 2026.
I just want to point out quickly that we do see in the pre-market, Bank of America and Morgan Stanley gaining. You can see that on your screen here. U.S. Bancorp, M&T Bank falling. Ostensibly, I'm correcting what Sonali said, but really it's Will Shaker who made the mistake. So
you could have just said our producer.
We blame you. No, I'm kidding.
But we love
I'm kidding around. We showed an intraday chart, and we meant to show a pre-market chart. In terms of the big banks versus the smaller banks, Gerard, have we already seen a lot of the money center banks' gains priced in? Because there's been so much optimism, post-election, or is there more to come in 2025?
I would say that you framed it out well, Matt, in that certainly the expectations and the hope from the new administration has been priced in. And now it's the execution and delivery. And should the banks be able to deliver on the numbers in an economy that's growing, let's call it 2 to 2.5%, and a positive slope yield curve? You pointed out earlier in the program about the 10-year coming down a bit, but we still have a positive slope to the curve. And if the Fed does move and lower rates, so let's call it 4% at the short end of the curve, the banks have not operated in a positive yield curve environment since 2022. And investors may remember that a positive yield curve environment is very positive for the net interest margins and net interest income growth, which will then benefit earnings growth. So it's really going to come down to the execution, because to your point, a lot of the hope is priced in based upon the incoming administration and the policies they will pursue.
Gerard, I'm glad you brought up the yield curve, because this is something I always wonder about. You point out the fact that we're positive when it comes to the 2s10s curve, looking at about 37 basis points. Something I always wonder is that for the banks, is it the level that matters, the absolute level, or is it the direction of travel and the rate of change?
It's a combination of both, Katie. I would say that the upfront curve, when we're down at 0 to 25 basis points and 100 basis points at the 10-year, when you go back to the tail end of the pandemic, that was not a very good environment. But when you can have an absolute level of the front end of the curve around 4% and the long end between 4.5 and 5, that is very positive. So ideally, we would like to see a positive slope to the curve between 50 and 100 basis points, and we'd like to see the front end of the curve stay well above 3%. In that environment, the banks can do very well in building up their revenue growth and profits in that kind of rate environment.
Gerard, I'm really curious as to, out of your coverage universe, your favorite bank to bet on right now, because you do see Morgan Stanley and JP Morgan having significant rises in the last couple of days on these earnings beats, but they're also trading at more than 2 times book. How do you then choose what has the most upside?
It's a good point, Sonali, because that is true. I mean, JP Morgan and Morgan Stanley have done a very good job, but their valuations are at the high end. Therefore, I think there's better value in names that are also putting up good numbers, but just don't trade at those valuations at this time. And a good example of this would be Bank of America. Also, the news yesterday with Citigroup coming out with that big buyback program, $20 billion. Citi is a great tactical trade, because we anticipate that as they execute on the buyback, And as we get final clarification on Basel III, there will be even more excess capital for this company to give back to shareholders. And when your stock is trading below tangible book value per share, as well as book value per share, there's no better way of accreting capital to your shareholders than doing a buyback. So if they were to raise the amount later this year, that would be an added positive. So Citi, on a tactical strategy standpoint, is a buy at these levels as well.
All right, Gerard, that's a good place to leave it. Always great to get your insights during bank earnings season. That is RBC's Gerard Cassidy. Now coming up, Treasury Secretary nominee Scott Bessent faces questions from the Senate Finance Committee in just over an hour. You can watch the full hearing on Live Go or follow our live blog on TLive Go. This is Bloomberg. Welcome back to Bloomberg Interest. Let's get a quick check on these markets. Just minutes until the bells ring. You can see a little bit of a rally on our hands. The S&P 500, the NASDAQ 100. We got softer than expected retail sales. That pairs really nicely with that miss that we saw on CPI yesterday. A huge rally that we saw yesterday. You're not seeing the follow through in the Russell 2000 right now. Your small caps just about unchanged. What was interesting, you guys, is that you take a look at the magnitude of the gains we saw yesterday. The S&P 500 now in positive territory for 2025, up 1.2%.
Finally. I mean, we were talking about how we've been below that 6,000 level, and it's really been bothering me.
Yeah, we bumped up against it a couple of times this year, but we haven't reached it on an open or a closing basis. I'm really focused on crude.
Are you?
Yeah. So there's a great story on the Bloomberg terminal by Ben Bardenstein, Nick Wadhams about the Trump team readying sanctions, getting ready to try and end the Russia-Ukraine war. Obviously, last Friday, we saw the Biden administration put new sanctions on crude, and it's risen by $5 a barrel since then.
Yeah, we'll see, of course, if that premium is sustained. We know it's hard to price in that geopolitical risk, but stick with us. The opening bell is up next.
Moments away from the start of trading after a blockbuster day yesterday. This is Bloomberg Open Interest. I'm Matt Miller. Futures are still up after a 1.8% gain on the S&P. We're looking at a gain in NASDAQ futures as well, almost 0.5% there. Russell 2000 futures unched, but we saw huge gains for small caps yesterday as well. You hear the opening bell ringing on the New York Stock Exchange. Down there, you've got the national championship ringing the opening bell. That is, I believe, Monday night. You're going to see the Ohio State Buckeyes absolutely destroy Notre Dame. And it's a really big game as well because these are two huge fan bases. Down at the NASDAQ market site, I'm told this is a reality TV star, Bethany Frankel, hugging a young girl, and she's celebrating or raising money for some philanthropic cause. In any case, hopefully she bought the S&P day before yesterday because she would have made a couple percent there. Katie, what do we see in terms of the major indexes?
Amazing segue back into these markets. We have a little bit of a follow through on that rally that we saw yesterday. The S&P 500 up about 0.1%. The NASDAQ 100 0.4%. Small caps really interesting. Of course, they are basically closely following what traders are thinking when it comes to the Fed expected rate cut trajectory. We saw some of those bets come back into the market yesterday. Maybe some question marks today because your small caps, the Russell 2000, currently unchanged. Let's take a look under the hood, though, and talk about United Health. Of course, it operates the largest U.S. health insurer. It reported fourth quarter revenue that missed analyst estimates this morning. Now, today's earnings call is its executive's first public remarks since a top executive was murdered last month. You can see shares currently off by about 1.9%, Sonali.
I want to look here also at the banks, of course, reporting earnings this morning. Bank of America profit topped estimates thanks to higher investment banking fees, strong net interest income, a better outlook, yet you are still seeing at the open the shares roughly unchanged. They had a big boost yesterday. Morgan Stanley reported revenue that blew past estimates. Stock is up almost 2%, 1.9% roughly as the market opens. U.S. Bancorp, however, down 5.7%. They had reported sluggish loan growth relative to expectations, increased competition for deposits. We're going to see more of that throughout this earnings season, Matt.
All right, we're also watching a slew of EV stocks. Polestar is one. That's the Volvo unit. They only make EVs, no gas engines, and they had disappointing revenue, and they lowered their annual outlook, so the stock is getting decimated. Meanwhile, the White House and the Energy Department finalizing plans for loans and loan guarantees to Rivian and Plug Power. Plug Power getting a loan guarantee for $1.7 billion to build some hydrogen plants. Rivian will get a loan of maybe as much as $6.6 billion to build its Georgia plant. So those shares are rising, although it has to be said that Trump administration officials, Vivek Ramaswamy has said, will be scrutinizing these 11th hour deals. We're going to speak with the CEO of ChargePoint in the next hour. Rick Wilmer joins us. They have a nationwide network that apparently has developed a vandalism-proof cord, because a lot of times these these EV charging stations are broken.
Yeah.
And they've come up with a solution to this.
Looking forward to that conversation. One of 3 CEOs that we'll be speaking with in this show. So a lot of great stuff coming up.
It's the CEO show.
It's the CEO show. It sure is. We have a great conversation right now, though, because joining us is State Street Head of Equity Research, Marija Veitmane. Marija, great to have you with us. I think of you as a pretty bullish individual. So I want to talk a little bit about the start to 2025. It feels like we saw the trade-off between the Trump trade, which really fueled gains towards the end of last year, and now we're back to worrying about the Fed, of course, and whether or not we're going to get all those rate cuts that maybe some of the bulls had been expecting. What do you think is the driver going forward from here?
Yeah, good morning. I mean, you're absolutely right. I've been very, very constructive on outlook for 2025. It's very interesting how sentiment has really swung. At the end of last year, I mean, the biggest criticism I heard from clients is that everybody optimistic. How can you be even more optimistic? And now the pessimism is kind of there, and we've had a big sell-off. I think it's really interesting that kind of the major kind of pushback to the bullish case what we have now on equities is this idea that, U.S. economy is too strong, we're not going to get rate cuts. I mean, I can see how that's absolutely detrimental for a bond market. I mean, for equity market, a stronger economy is still better earnings, which is quite supportive. So I think in terms of like key drivers, it's really earnings outlook. And I think it was really interesting in your introduction how you showed some companies that miss estimates are really, really punished and good earnings are very much rewarded. So that's really the story for us, watching for better earnings stories.
Speaking of earnings, there's also the earnings as it relates to the economic data as well. A lot of investors trying to parse through what they're seeing. I want to target here the retail sales data that came out this morning. That came in a little weaker than expected, even with advancing. And then also bring in this whole idea of how the retailers are doing. Target is dropping right now because of an indication here that discounting promotions may have hurt profitability. The holiday season really pointed to deceleration. It's similar to what we heard from Macy's a little earlier this week as well. Do you have any concerns about the consumer and the read-through to the consumer sector, especially because that consumer discretionary sector in particular was holding up the S&P 500 at the end of last year?
Yeah, no, it's a really good point. And again, earnings are the key. Consumer is really important. And what we're seeing is really kind of very wide dispersion in terms of kind of consumer health. So you have one demographic, but maybe kind of a younger consumer, which still needs to buy a lot of goods. So those people need to, starting their families, they're buying houses, they're buying furniture, they're buying electronics. And they are in the beginning of their careers and they more reliant on consumer credit, and which is still really, really expensive. So even despite the rate cuts, we haven't seen really significant reduction in like credit card costs and things like that. Car loans, so they're still very, very expensive. So that's one demographic, and it's kind of challenged, and we're seeing cracks here and there. And then there is another demographic, people with savings. So they really benefited from higher interest rates, and their savings are good. So consumer is really not uniform. And in general, people with saving, maybe slightly older demographics, they spend more money on services rather than goods. So maybe there is a play there, prefer kind of consumer service to consumer goods. But yes, I think it's very, very company specific stories that need to be watched.
I want to go back to your first comment about the criticisms of the bull case. And I don't think it's all about a strong economy in the U.S., not enough cuts from the Fed. I think a lot of criticism centers around the valuations, right? I get that stocks over the long run are going to go up. But if we're paying 30, 40, 60, 120 times earnings, you know, at some point, it's just too expensive. At some point, a chip maker maybe shouldn't be worth $3.5 trillion, or a phone maker worth $4 trillion. At what point do you draw the line and say, okay, we've invested fully and we can't get any higher here?
Yeah, that's a really good point as well. So the way we're kind of thinking about markets is that what we really, really want to buy is companies with like quality earnings. So particularly if we are worried that rate cuts maybe are not forthcoming and rates are going to stay high. So where can we find companies that are going to kind of have stable margins and protect the earnings, that may be less cyclical in terms of their revenue? And interestingly enough, those are kind of, so if you look at quality, there is a huge overlap between quality and growth, quality and large caps. So in a way, those really expensive and like tech companies, as an example, they're the ones that arguably are better quality, are somewhat insulated from kind of swings and cycles and higher interest rates and higher cost of living and consumer kind of running out of money. So you have this huge overlap between like quality and growth. Yes, those stocks are expensive, but you want to buy quality if you're worried about kind of economic slowdown. So that's an interesting angle. While if we look at value companies that are trading at a very cheap multiples, they're really the companies where earnings are really challenged, and investors are really not giving benefit of a doubt to companies with weak earnings.
Marija, we thank you so much for joining us today. Of course, complicated market to navigate. State Street's Marija Veitmane. Now, coming up, what's better than an annual rebalancing? A semi-annual rebalancing. FTSE Russell CEO Fiona Basset joins us for the latest news in small caps. This is Bloomberg.
All right, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Netflix getting upgraded to a buy over at Seaport. The analyst says that the stock should remain a core holding and expects that tailwinds will support its industry lead. Netflix reports earnings next week. Next up, Southwest getting downgraded to sell over at Citi. Analysts note that the airline's earnings quality and free cash flow looks weaker than before the pandemic. And finally, we have Oppenheimer initiating coverage of Mobileye with a buy rating. The firm says that the automated driving company has multiple growth avenues, and also that headwinds from China are misunderstood by the street. You can see shares up about 3.2%. Meanwhile, switching gears here, since 1989, the Russell U.S. Index, the world's third largest index provider, held an annual rebalancing. That's all changing. Today, the FTSE Russell is announcing an additional rebalancing date, making it a semi-annual event that will take place in June and in November, beginning next year. Here to discuss, I'm pleased to say, we have Fiona Basset. She is the CEO of FTSE Russell. So Fiona, you've been doing it the same way for over 30 years. Why make this change now in this market?
So good morning, Katie. First off, thank you for having me on the show today. Really great to be here. But look, I mean, as you know, Russell indexes are a hugely important flagship benchmarks for the US equity market. They're not only the broadest, most accurate and transparent representation of the US market, but are also systemically key, with over 10 trillion of assets that are tracking these indexes across the investment community. Since starting at the helm of FTSE Russell, like 17 months ago now, I spent a lot of time with our clients around the world on how we can best serve their needs as their index provider of choice. And it was evident from those discussions that there was clear demand to move to semi-annual reconstitution. The Russell franchise has grown strongly over time, and reflecting both the demand for US equities, not just here in the US, but across the world as well, as the value proposition of Russell itself.
Right.
We're a strong believer that the choice of index matters.
Right.
And this growth has just to talk about this a little bit, the growth has generated increased attention to the frequency of the Russell US index reconstitution. To share some stats with you, Since 2019, the dollar amount traded at the close of the reconstitution has consistently exceeded 100 billion. And in fact, the June 24 was a record 220. So we've also seen a pickup in US equity market volatility. And based on the client feedback and those market dynamics, we decided to conduct a formal consultation.
Well, Fiona, that's what I'm curious to get your thoughts on, because you talk about the Russell rebalancing trade. It's well known in the markets, of course, in June. And like you mentioned, of course, the June 2024 rebalance, that trading volume of about $220 billion, definitely breaking records there. What impact would you expect this semi-annual rebalance to have on that trade?
So first and foremost, we're doing this because it will ensure the indexes are more dynamic and therefore better representations of the market. We expect that there will be a reduced size of the rebalance for the reconstitution in June, which will also help lower the operational burden of execution. And the semi-annual rebalance will also smooth out the index changes. We've obviously done extensive simulation of the turnover and the transaction cost of moving, which shows a modest decrease at the June reconstitution and a modest increase in the second rebalance. And the feedback from the consultation really indicated that any expected increase in turnover, which we expect not to be material, is reasonable relative to the benefits of moving to the semi-annual reconstitution to maintain the accuracy and representation of the markets that Russell is known for.
Fiona, what does this all mean for the constitution here of these indices? If you look at the types of companies that are making their way up, certainly we have seen certain companies related to AI, even GLP-1, certain hot industries here just take off in terms of how they have been traded. Does this mean that the makeup of the index is changing extremely drastically?
No, not at all. I mean, the fundamental methodology for the Russell indices will actually stay the same. This is really a question of increasing the rebalance to a semi-annual process. And as part of that, to make sure that the index is a dynamic representation of that market. I think one of the benefits of this, obviously, is that and I think the benefit of actually Russell more broadly is it's always been very responsive to changes in the market dynamics. And you can see that, I think, one of the differentiations of Russell, in fact, relative to other US equity market indices is it's not only transparent, but the inclusion of stocks post-IPO as soon as they meet the threshold goes in. So there are a number of distinguishing features of Russell, but we're not expecting the rebalance to materially affect the structure of the index itself.
I'll ask the stupid question, since these two ladies here are so steeped in market structure. Why not rebalance if you want to do it dynamically on a daily basis? I mean, in the age of blockchain, and digital management, can't you do it all the time? Why only twice a year?
Yeah, it's a great question. It's a trade-off really between ensuring the kind of representation and also minimizing the turnover and transaction costs associated with that. And so having done extensive market research and consulted with our clients, we believe the semi-annual process is the best balance for the market.
Is it going to take another 30 years for you to potentially change? I mean, we're at semi-annual right now. And I mean, looking through the press release, one of the reasons you name is volatility. It feels like markets are just getting more and more volatile. I mean, how often do you think that you could make these sorts of changes?
So obviously we review our lineup all the time. The primary focus is on ensuring that the indexes continue to be representative of the markets. Clearly there has been a structural pickup in volatility. And I think not just that, but to reflect the growth of Russell and the management of the execution of rebalances, we've chosen to do that semi-annually. Obviously, we'll continue to evolve our index lineup through time. But as I say, we expect this change and the indices to stay the course of time.
So we're talking, of course, about the universe of your U.S. indexes, and one of the most well-known ones is probably the Russell 2000. Of course, the small caps index, we talk about it all the time on this show. I want to talk about the definition of a small cap, because typically people think of about $2 billion, and it just feels like companies are getting bigger and bigger, and you also aren't necessarily seeing the supply of those much smaller companies get replenished because there's been a bit of a drought in the IPO market. Could you see lifting the ceiling on what is considered a small cap away from $2 billion?
So, as I say, we consistently review the methodology to make sure that it's representative of the market. We believe the way that the Russell 2000 is currently constructed, it is fit for the market and its purposes. Clearly, I think one of the interesting things is the potential for pent-up demand around the IPO space. I think one of the things that I think is a differentiator, as I mentioned earlier, for Russell, is the fact that our indices allow for immediate eligibility once they've IPO'd and met that threshold criteria, which, as I say, like if you look at Tesla, for example, is a great example of that in the context of Russell 1000, that when that IPO'd in 2010, we put that straight into the index. And I think if you look at other competitor indices, in fact, actually Tesla didn't make that debut until 2020. So I think we feel very confident in our methodology and that is transparent and allows us to incorporate companies that are growing and meeting the criteria for whether it's small or mid or large.
Fiona, we have to leave it there. We thank you so much for joining us. That is the CEO of FTSE Russell, Fiona Basset. Now, I want to check on markets here because you have seen them take a leg lower. You have seen them reverse from earlier gains. And we do have, it's not much. I mean, it's pretty much unchanged. However, I do think that the sectors leading the market lower are interesting. You are led lower by consumer discretionary in the S&P 500. That is Tesla, but it's also the likes of Lululemon, McDonald's, Airbnb. Really interesting move after the retail data that we saw this week, guys.
I will note that volume is a little bit lower right now. It still feels like we're in a wait and see mode. What we're waiting for, I'm not sure. I guess you could say, of course, it's inauguration, it's the next Fed meeting, it's earnings maybe kicking off in earnest. I know we've had the big banks, but it's a pretty light.
Yeah, I mean, we're getting as I was saying earlier, $3 trillion worth of earnings this week. Next week, a little bit more than $4 trillion worth of earnings. The week after that, $22 trillion worth of earnings. So that's when earnings season really kicks off and we get the big tech stocks. We will be right back with the latest bank earnings headlines. This is Bloomberg.
Checking back in on the bank stocks because today is not as good as yesterday. Despite some banner performance that we've seen, Bank of America is pretty sluggish this morning, only up about 0.25%. Morgan Stanley still flying 1.7% higher. U.S. Bancorp down. Worries about sluggish loan growth over there and more across the regional banking system. I want to show you a chart, guys. Bank of America's book value, price to book, is the lowest among its bigger rivals. You're seeing a hefty premium given. Morgan Stanley, JP Morgan trading at more than 2 times book, and Goldman Sachs getting closer to it.
It's amazing to see those price to book ratios. I remember not long ago reporting on price to book ratios that were all below 1.
Wow.
Now, granted, I was sitting in Frankfurt at the time and
like 50
talking about German
ago.
banks. And they're probably still down there.
Yeah.
But yeah, I mean, that's strong for U.S. banks. And you can see the growth here that we've seen. In white, you've got JP Morgan Chase. In blue, you got Bank America. In red, you got Wells Fargo. And in yellow, you got Citi bringing up the rear.
Does Bank of America deserve to be trading below where Wells Fargo is in price to book? I think that's a fascinating dynamic.
I would ask you that question because I don't know.
They just boosted their net interest income expectations, and you don't have the market biting. And you know what's
Bank
interesting?
Bank America did have like a 48% growth in investment banking revenues. So
yeah, and at the end of this year, they're expected to bring $1 billion more in a single quarter for net interest income. But again, yesterday you did see the KBW index rise, the most since the election. So.
All right, coming up in the next hour, we have Adam Hetts of Janus Henderson, also the CEO of ChargePoint, also the CEO of Halozyme Therapeutics. All that and more coming up.
All right, we are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And coming up, muted moves. Investors are weighing a mixed bag of economic data with more solid results from Wall Street.
Powering up, ChargePoint CEO Rick Wilmer tells us how the world's largest EV charging network is combating vandalism and bracing for the incoming Trump administration.
And defending the dollar, Trump's Treasury Secretary pick Scott Bessent faces senators at his confirmation hearing later this hour. Let's get a check on these markets. Of course, as Matt said, 30 minutes into this trading day, we've taken a leg lower. The S&P 500 now down by about 0.2%. We had been sitting on gains of about the same magnitude, but that has been erased in light trading overall. Not a lot of volume today. The Nasdaq 100 also down by a similar magnitude, down 0.2%. We're a long way away from yesterday when we saw those big gains come through at the closing bell. But of course, the day is young. You take a look at the bond market, pretty consistent in its moves this morning. 10-year Treasury yields up between 1 and 2 basis points. We're hanging out just below 470, Matt.
Yeah, and those rates are what I want to kick it off with Adam Hetts. He's Janus Henderson Global Head of Multi-Asset and Portfolio Manager there. And, you know, we had been talking for weeks about 450 as the danger zone, Adam. As we got closer to 5, that looked a lot worse, and we saw equity indexes plummet. Do you feel more comfortable here at 466? Is that okay moving along, or is it even a signal of a strong U.S. economy?
Well, hi, Matt, Katie, Sonali, thanks for having me on. And in short, yeah, we're feeling more comfortable, but it's been a dramatic week. We had the strong NFP on Friday a week ago, of course, and that pushed the rate cuts back to October. And then we had a more comfortable CPI yesterday, so that pushed the rate cuts forward and went from 1 cut and potentially a hike now to 1 to maybe 2 cuts again. So that's better. I think we're feeling comfortable because we just need to zoom out. I think the market needs to zoom out and just tune into the fact that the big driving force here, it's not the pressure on rates or inflation, it's a strong, resilient late cycle economy. And that should give everybody comfort. So even though it's creating that pressure, I think the economy has good intentions. And it's a rich market. It's a very highly valued market. It multiples over about 30% more than long-term averages. So it's going to be really sensitive to these short-term repricings. But again, that late cycle, kind of extended cycle economy, that's still a profound good thing for medium-term investors.
So there are a lot of moments coming up as well that could change a lot of what we're talking about now. Adam, you think about just a half an hour from now, the hearing for Scott Bessent as the next Treasury Secretary kicks off. 4 days from now is inauguration. If you think about the catalysts that are upcoming, what is going to be the biggest thing that could change your thinking around the direction of yields?
There is a bit of just looking for a catalyst right now, and it brings data dependent back into the forefront of the conversation. A reminder of that's the world that we're in right now, is very sensitive to the data. So next week, it's the new administration. And if you look in the rearview mirror, you think that they're inheriting a great economy and a great market. But going forward, it's actually a brutal economy or a brutal market to inherit, because I think there's so much more downside than potential upside, which is just at this point sort of just grinding higher. So as we're thinking about the administration coming in, it's pro-business, pro-market administration, and I certainly don't want to be the one to coin the term Trump put here, but you know that the administration is going to try to support the market. So if we do get some bad data or some bad catalysts, maybe the policy levers switch from tariffs to taxes, for example, sooner than some people might expect. You know, hopefully the economy and the market can survive on their own tailwinds, but smaller or larger, the administration should be a tailwind. But there'll be plenty of uncertain headlines along the way, we're sure.
Adam, is that the bull case that Trump put, or would you add a little bit more meat to that argument?
I think the bull case is more just tuning back into the economy and the strong data that we're still seeing. It's a richly valued market. That's not a great indicator for long-term returns on a historical basis. But if the market can support these elevated multiples, you got to focus on earnings, and you got to focus on the earnings delivery this year. And consensus is still in the teens, a little bit higher as you get into the other 493 in the S&P. So we think that sort of status quo, if we can get some stability in the data, you don't need that tailwind from the administration as much. You just need this delivery on earnings, which so far is so good on that front.
You know, for weeks, For months, we would ask investors and economists alike if they were worried about inflation rearing its ugly head again, and everyone sort of poo-pooed that idea. No, we're on our way back down. We're comfortable with the trajectory of, CPI, PCE. And then all of a sudden, we got freaked out by not only the jobs number, but a jump in prices paid, ISM prices paid. Are you at all concerned about that coming back this year? Because it seems to me there could be so many catalysts, from tariffs to deportations.
We're not concerned. There are lingering concerns, but the base case is still optimism here in this grind higher in the late cycle environment. But it's a good point. I think when you look through what's driving these inflation figures, there's a lot of demand drivers. This isn't like the chaos created during COVID on the supply bottleneck. So it's kind of demand-driven inflation pressures, which is good owing to the strong economy and the strong consumer. So we're not primarily concerned, but we also don't think we're completely out of the woods as far as the long and variable lags of all the rate hikes we've just survived. So it could be from inflation rearing its head again and being stickier than expected, or just the fact that, face it, we're only 3 years into this hiking cycle. We think a lot about the hiking cycle we had in the aughts, started in 2004 and ended when the economy hit that brick wall in 2008. If you map where we are today onto that hiking cycle, you could say today is like 2007. So we don't think 2026 is going to be the 2008 coming up, but we are watching those credit conditions. I think there's a good reason to be optimistic about credit conditions, still a green light for now, but I think it is good and healthy to be concerned and still think about those long and variable lags.
I want to go back to one of the comments you made a little earlier about more downside risk from here. One question we've been asking a lot of is, how do you figure out what the upper bound is on the 10-year or what the floor is on the S&P 500? Do you think it's just too early to call?
I'll take the easy way out on that one, on the floor of the S&P. I think on the upside, when you're talking about those mid-teens earnings expectations, you can't really expect reasonably a lot of expansion on multiples from here. So you're going to drive a lot of your index returns from earnings. That's the upside, sort of that low double digit index returns from earnings. On the downside, we think about that a lot. If you have a recessionary environment or you have a hard landing that comes sooner than expected from the soft landing environment, earnings can be revised down 10% in a heartbeat. Multiples are 30% elevated, so between a bit of a multiple derating and an earnings revision, that can spell a 20% bear market pretty quickly, and that can be really dangerous for investors, where if it's still a strong economy and there's just a bit of a reset in sentiment and expectations, you need to stay invested through that. But if that happens alongside the economic data also turning south, then that's a bit of a different conversation and a bit of a different risk management approach to our portfolios.
All right, Adam, got to leave it there. Always great to speak with you. That is Adam Hetts of Janus Henderson. Of course, Adam said it was 2007. Sinead Colton told us it was the 90s. Actually, it's 2025. Let's talk about what's happening right now in this market and take a look at the stocks moving at this hour. We'll talk with Bloomberg's Alex Semenova.
Hey guys, I'm taking a look at Taiwan Semiconductor. That stock is up more than 5% right now after the company projected quarterly sales and capital expenditure that exceeded Wall Street estimates, driven, of course, by what seems like insatiable demand for AI hardware. This is, of course, the chip maker for giants like Apple. It forecasts revenue of $25 billion to $25.8 billion in the March quarter, of course, exceeding analyst predictions. And it plans to spend up to $42 billion on tech and capacity upgrades this year. This is offsetting some concern about the tension between U.S. and China on tech and broadly lifting optimism around the AI spending cycle. Another name I am taking a look at is Target, of course, a bellwether for the U.S. consumer. They actually raised their sales guidance following a better than expected holiday season. They expect comparable sales to now grow by about 1.5%. That's up from flat before. They have been kind of struggling with sales for non-essential goods. That's kind of their strongest category. But they had a really good holiday season, and that's expected to bode well. Investors aren't happy, though. The stock is down about 4% right now. And finally, last but not least, Morgan Stanley is adding to robust results from the big banks. They reported fourth quarter profit that more than doubled. That stock is up more than 1% right now. Their performance was boosted by trading revenue that came in ahead of Wall Street estimates, of course, tied to volatility around the U.S. election. That helped boost net income to $3.72 billion. And shares of Morgan Stanley are up about 52% in the past 12 months.
Cool. Alex, thanks so much. Bloomberg's
Thank you,
Alex Semenova there talking us through some of the big movers today. Coming up, America's largest public EV charging network is announcing a new host of features to deter theft and vandalism. We'll speak with the CEO of ChargePoint, Rick Wilmer, next. This is Bloomberg. Let's get now to high interest, a look at what's making headlines around the world. BP is cutting around 5% of its workforce. That's 4,700 jobs internally and about 3,000 contractors. The news was broken to staff by the CEO, Murray Auchincloss, earlier today. He added that more cost-cutting efforts planned for this year and beyond. The oil giant has stopped or paused 30 projects since June last year to focus on the projects that make the most money. That makes sense. The company has fallen further behind its peers in the energy space, with its market cap now half of Shell's and below ConocoPhillips as well. HSBC, the Hong Kong Shanghai Banking Corporation, set to buck the trend on banker bonuses. Bloomberg has learned that HSBC is gearing up to pare back compensation as its new CEO gears up for multi-billion-dollar cost cuts. Employees and corporate and institutional banking have been warned to expect lower payouts. Meanwhile, the rest of the industry is going the other way and raising bonuses. No final decision has been made on HSBC incentives, but internal guidance says the bonus award is likely to disappoint in the coming weeks. And shares of Richemont have been soaring in Swiss trading after sales surprised investors with a 10% jump over the holiday season. Analysts had only expected gains of less than 1% in the quarter. The boost came largely from expensive jewelry purchases in Europe and the Americas, helping to offset weak watch sales. Shares in LVMH and other luxury names also on the rise. Bank America upgraded its recommendation on the French luxury goods giant, signaling more optimism for the sector going forward. Finally, ChargePoint is announcing the EV industry's first cut-resistant charging cable, as well as an alarm system. That's as it attempts to deter theft and vandalism. It expects the cables to be available for license by the middle of this year. And joining us now to talk more about that is ChargePoint's CEO, Rick Wilmer. Rick, great to get you on the program. I want to ask how big of a problem this was in the first place. I mean, I know a lot of people are disappointed when they pull up to an EV charger and it doesn't work. Is that happening a lot more often, and is it due to vandalism?
Yeah, it definitely has been a problem that has been pervasive and getting worse. I think the rumor out there is that as copper prices go up, thieves believe they can make money stealing charging cables and taking them to recycling centers. And we've seen hundreds and hundreds of chargers get vandalized, and I bet industry-wide it's in the thousands. Seems to be concentrated in different areas. It surges in certain parts of the country and then builds up again in another part of the country. We've also seen it with some of our customers in Europe where they've got charging cables attached to chargers. So it's been a real problem. It's been very frustrating.
You know, one reason the vandalism exists also is to get access to that copper that's underneath the surface there. And I want to pull up actually the price of copper, because interestingly enough, it has been back on the rise after a fairly steep decline at the end of last year. I'm wondering what this means for you in terms of pricing, in terms of what your inputs are costing right now.
Yeah, good question. But quite frankly, the cost of copper as part of the overall cost of a charging station is not all that significant. And I think a lot of the thieves aren't that intelligent and, you know, hear a rumor or see something that makes them think they can make money. And it turns out there's just not that much value there.
I want to talk a little bit more about reliability. Of course, if your chargers are being vandalized, that would be a point of reliability becoming an issue. But let's also talk about software. Like Matt mentioned, making sure that these chargers work every single time for all types of EVs. How much time do you spend on the software, making sure that that actually is the case?
That is our single biggest area of investment and innovation. Like many other industries, software is going to eat the world in EV charging. So we spend a lot of time not only making charging reliable through software, making it easy to find, use, and pay for charging, but also to develop all kinds of interesting new features that our customers can take advantage of to not only drive utilization of charging at their institutions, but also to drive their core business.
Rick, I wonder about EV growth. There had been clearly a big backlash, and with Donald Trump coming into office, you may think, well, he's going to, remove the credit and slow EV sales even further. On the other hand, Elon Musk has purchased himself a place at the table here. Do you expect EV growth to pick up again, or is it going to continue to slow in 2025?
No, I don't think it's going to slow at all. In fact, Bloomberg New Energy just forecasted earlier this week 28% growth for EVs in North America this year and 33% in Europe. And I think what's really driving that, and it overcomes, government incentives or lack of, is really market forces. And I think what's held EVs back in the past, on one side of the equation, is just a lack of selection of vehicles. So we're going to see dozens of new EV models introduced this year, different types of vehicles, lower price points, and I think that's really going to help adoption. And then on the charging side, we continue to grow our networks. We continue to deploy more chargers. And innovations like we announced today around making chargers more reliable by preventing vandalism is going to help the other side of the equation, where drivers are concerned about finding a charger and when they do find one, making sure that it works.
Is it possible, it's possible to charge Tesla at a ChargePoint station, but do you have a significant number of Tesla owners charging at your stations?
Yes, a lot. If you walk into our parking lot, there's probably more Teslas out here charging than there are any other make of vehicle, just because they're so prevalent on the road.
What do you think this means for Tesla? A lot of people are talking about Elon Musk's closeness to the president-elect at the moment. Do you think that that's going to give him an advantage relative to other EV companies out there, especially because they're already very much in the lead when you think about the standalone EV companies?
It's so hard to know. I really believe that what drives EV sales is the superiority of an electric vehicle versus an internal combustion vehicle. And again, like I mentioned earlier, as more models become available that meet the needs of different types of drivers that require different kinds of vehicles and at a variety of price points, the market's going to grow. I think they're just a superior product to the internal combustion vehicle.
Rick, as you know, I have a podcast called Hot Pursuit with Hannah Elliott, where we talk basically about our love for cars. And there's some exciting EVs coming out. I think Hannah's going to drive a Porsche Macan EV next week. What are you most excited about in terms of product offering in 2025?
Wow, there's so much coming. I think the Macan is an exciting vehicle. I'm excited to see some of the Stellantis vehicles come out. There's just a lot coming that I'm excited about. By the way, Matt, big fan of the podcast. I listen to that pretty regularly.
Well, I really appreciate it, Rick. Thanks so much for joining us on Bloomberg Television as well. ChargePoint CEO Rick Wilmer. For more on all things auto, go ahead and check out my podcast with Hannah Elliott. It is called Hot Pursuit, and you can get it on Bloomberg.com or anywhere you get your podcast.
I will be listening to the Macan episode.
Yeah.
That's the car I want.
You should check it out. It's a pretty hot car. I think Matt Farah actually just got one from the Smoking Tire, not to mention a competitive
But
podcast.
Is it too hot?
Hot. Too hot. Still ahead, Wall Street's preeminent short seller is calling it quits. We'll discuss, the end of Hindenburg. This is Bloomberg.
All right, it's time now for Social Climbers. The company's making waves this morning. And first up, the Department of Transportation is suing Southwest Airlines on allegations that it operated 2 chronically delayed flights in 2022. The DOT said that flights from Chicago to Oakland and from Baltimore to Cleveland arrived late almost 200 times between April and August that year. Southwest, for its part, said it is, quote, disappointed the agency chose to file a lawsuit over 2 flights that occurred more than 2 years ago. Next up, Nintendo says it will reveal the next generation Switch 2 on April 2nd. The new console will be similar in design and concept to the 8-year-old gaming console that exists right now, and game developers are counting on the new platform to jumpstart lackluster momentum in the industry. And finally, we have famed short seller Nate Anderson. Remember, he made his names with campaigns targeting billionaires. He said yesterday that he's disbanding his firm, Hindenburg Research. In a letter posted to the company website, he said there was no specific reason that led to this decision. And remember, Anderson made international waves 2 years ago after publishing a report accusing Indian tycoon Adani of pulling the largest con in corporate history. He also published reports on Block and Icon Enterprises, and just actually a few weeks ago, Carvana as well. Make sure to check out my podcast. I have one too, Matt Miller. It's with the other Matt Levine. It's called Money Stuff. We will absolutely be discussing Hindenburg Research and, of course, Nate Anderson's decision, which made a lot of waves yesterday.
Yeah, I thought it was kind of a sad moment because Hindenburg has been so successful and exciting, really, right, for the industry.
Pretty good track record, I would say, at least compared to some of their peers.
You know, there was Hindenburg, there was Jim Chanos as well. A lot of people in the short selling world throwing
Andrew
in the towel.
left.
Yeah, and you know what's interesting to me is actually maybe this will spawn some new Hindenburg babies, because he says that some of his employees are actually going to go out and form potentially new research firms.
Yeah, and he said he encouraged that as well. So it'll be interesting to see the alumni class potentially emerge from Hindenburg shutting its doors.
They'll never come up with a better name, though.
Hindenburg?
Dropping from the sky like a Led Zeppelin. Actually, they could be called, you could start a new firm called Led Zeppelin, which would be pretty cool.
Carson Block is going to be going it alone.
All right, coming up, Halozyme Therapeutics is on a mission to replace intravenous delivery. We'll speak to Helen Torley, Halozyme Therapeutics CEO, next about skin pops. This is Bloomberg.
Well, biopharma company Halozyme Therapeutics is on a mission to replace IV delivery. The biopharma company develops subcutaneous devices to make it easier and quicker to inject high-volume drugs into patients. Now, Halozyme has licensed its enhanced platform to companies including Roche and J&J, and I'm pleased to say that CEO Dr. Helen Torley joins us now. And Helen, it's great to have you with us. I want to talk a little bit about how your business works. My understanding is that you don't necessarily develop the drugs in and of themselves, but you make money on the licensing fees when it comes to partnering with these companies.
That is correct. We have this enhanced drug delivery technology. It's actually an enzyme that can be combined with partner drugs that they, as you mentioned, Johnson & Johnson, Bristol, Roche are developing those drugs. But often those drugs have to be given in lengthy intravenous infusions. It can sometimes take 4 to 6 hours for a patient sitting in an infusion suite. And so what we do is license and partner with that company to create a new drug that includes our enzyme that then allows it, instead of 4 to 6 hours for one of our drugs, it to be given in just 3 to 5 minutes in a short injection underneath the skin. You can imagine that time saving means a lot for patients, but also it's much simpler to deliver drugs that way. And so patients are finding the benefit of also being able to receive treatment closer to home, perhaps a community hospital, instead of having to go to the large academic hospital for the IV infusion. And some of our patients are even, with some of our drugs, able to inject themselves at home. And so that's our mission, is really to make it easier for patients to receive important treatments for cancer, multiple sclerosis, autoimmune diseases. And yes, we're very proud to have over 800,000 patients now who've received drugs that have been delivered sub-Q with our enhanced technology.
How is it possible, Helen, because I imagine it must also be a far smaller volume of the actual solution, right? If I'm sitting with an IV for hours, that's a lot more liquid than if I just inject myself like I would with Ozempic or some other subcutaneous shot.
Now, great point. When drugs are being delivered to be given IV, the companies aren't really thinking about the volume because it doesn't matter so much. What we have found is that companies can concentrate the volume down, and so most of our drugs are between 10 mLs and 15 mLs, which is still a reasonable size volume, but that can be injected in just 3 to 5 minutes for most of our drugs. And we actually have a recently approved drug from a very innovative biotech company called Janus that is 5 mLs. It can go in as little as 30 seconds to 90 seconds. And patients are able to do that in some parts of the world all by themselves as well. And so it's a little bit of concentration technology that's happening in the companies. But what happens is our enzyme allows, and by creating basically a pocket underneath the skin, allows the drug to go in and spread and not cause a big lump, not cause a pain. And that really then allows it to get absorbed.
Yeah, I mean, you pardon my lack of scientific knowledge, but it seems to me it would be a very short step from a subcutaneous injection to a pill.
So the challenge is we're working with drugs that are called proteins or biologics. And unfortunately, today, it's impossible to take those by mouth because the stomach acids really degrade them. Now, there are companies who are working on that, but we're many, many years away from it. So for these protein drugs and monoclonal antibodies you might heard about, they have to be given systemically, so either into the vein or underneath the skin, because then it protects them from getting degraded by the stomach acids.
Helen, after Katie's return from the JP Morgan Healthcare Conference, obviously mergers and acquisitions have been a major conversation, and it's something that you've engaged with at Halozyme, recently withdrawing a proposal to buy Evotec after an unwillingness to engage. I think it's really interesting. You actually have seen the shares of Evotec decline fairly meaningfully since the end of that deal. Are you looking to go back, whether it's to that deal or any other at this point in time? How are you thinking about this?
Yes, we've mentioned the enhanced business model. It's a licensing model. It's resulting in strong revenues for the company. As an example, this year we expect $1 billion. That'll grow to $1.8 billion. And it's a high margin business, and so we have high free cash flow. We look at M&A as a terrific way to use this cash to be able to create value for our shareholders. So we continue to be interested in M&A as a way for us to add to, diversify, and extend our revenues, with a goal to continue to grow at the double-digit rate in terms of revenue for the next decade and even beyond that. And so we're looking for similar platforms to what we do today. We excel at partnering innovations. And so we'd like to find additional technologies that would be this partnering model that would allow us to meet these revenue goals and demonstrate continued success and growth of the company.
Well, that's where I wanted to go, kind of how you're thinking about partnerships versus M&A, because you take a look at Evotec, which, of course, you bid for and then you withdrew the bid. That was a German drug developer. It still is, but I'm curious, I mean, when you're thinking about partnerships now in this potentially friendlier regulatory environment that we might get under the Trump administration, could you shift to maybe some more outright M&A versus the partnership model that has worked for you?
Yeah, you know, we look at the partnership model as being a very compelling and differentiated skill that we have. To be able to take an innovation, commercialize it to create a billion-dollar revenue company is quite unusual. And there's lots of other opportunities out there for doing that. The Evotec model, I think people are probably less familiar with that, but we certainly found our investors well. But they have excelled at partnering as well. And so we do see that as a way where we can use our differentiated skills to create value and add more and more of these types of platforms is really what makes a difference for Halozyme. And so the M&A would be focused on acquiring a new platform, but then leveraging these terrific commercialization skills of innovation that we've so strongly demonstrated over the last years.
So we'll keep an eye out for that. I do want to ask you about the pipeline before we let you go. Of course, you talk about these partnerships that you have with the different companies. You do get some rejections. I mean, you take a look at last month, injectable drug from Johnson & Johnson was rejected by the FDA when it comes to using your technology. What do you have planned right now? I mean, how many more partnerships for different drugs can we expect roughly in 2025?
You know, actually, we have a very strong track record of success for all of the filings that our partners have done. They have resulted in regulatory approval. And so we do actually find that because we're now tested in 800,000 patients, we have a strong track record of safety that's demonstrated with that. The regulatory authorities are actually embracing our technology, making it easier for our partners to get approvals with shorter, simpler clinical studies. And so we just had 3 approvals at the end of the year, actually, including for a terrific drug from Bristol Myers Squibb, which is called Opdivo. That is now available as a subcutaneous drug. And our partners received approvals, 2 different partners for treatment of a rare neurological disease called CIDP. So just a very strong track record of success once people enter into late-stage clinical development with 100% success to date.
Helen, we thank you so much for your time today. That is Helen Torley of Halozyme Therapeutics. Now coming up, President-elect Donald Trump's inauguration is just days away. BlackRock's Rick Rieder sat down with Bloomberg's Wall Street Week to discuss how the new administration could shake up markets and how investors are preparing. And happening right now, the gavel has hit the table. Scott Bessent, Trump's nominee for Treasury Secretary, is set to testify before the Senate Finance Committee. This is expected to be, once again, a very partisan hearing. No shortage of fighting, guys, that we've seen in this hearing process so far.
I could imagine this being a lot more bipartisan than any of the hearings we've seen so far this week. Scott Bessent is going to have some support on both sides of the aisle, and that was not the case for Pete Hegseth, for example, and probably not as much the case for Pamela Bondi either.
Well, it's interesting. I mean, Elizabeth Warren, for example, she's called Bessent smart and thoughtful. Overall, she's not a fan, but she had some nice words to say for him. So it'll be interesting, of course, to see the balance of substance versus soundbite.
And maybe the Treasury market will come into play. Who knows?
I would imagine
Smart
so.
question for
Looks like he brought his son there. All right. Well, we'll continue to bring you any headlines that cross as soon as Scott Bessent starts to speak. You can watch the full hearing on the Bloomberg terminal. Just type LIVE GO or follow our live blog at TLive. Maybe that's an intern. This is Bloomberg.
A Treasury Secretary heads the agency charged with supporting economic growth, representing U.S. interests before foreign nations and global financial markets and organizations.
Well, it's time now for our daily Wall Street Week conversation, and President-elect Donald Trump's inauguration just days away. And as Trump readies his White House return, investors keeping a watchful eye on how his policies could impact the markets. Wall Street Week host David Westham sat down with Rick Rieder. He is BlackRock's CIO of Global Fixed Income, to talk about how the Trump administration plans to achieve growth. It's part of Wall Street Week's special coverage of the inauguration.
What the markets care about is there a plan? And I thought one of the key things we said by 2028, there's a plan in place. Oftentimes you have elected officials like, we're going to spend and we're going to do it now. It has to be a progression, but it has to be a thoughtful progression around how do we get spending down, but we don't do it to really disrupt the system, but there are thoughtful ways to get there. And my sense is there's a series of initiatives they're thinking about how to get it down, how to restrain spending, and then come up with a consistent plan. Listen, the debt is the biggest problem. The U.S. economy is in incredible shape. I mean, the vibrance of this economy blows people away. I mean, how many times last year we arrest a recession? Economy just moves along. There's one risk that's out there, and that is the debt burden. If we have a plan to bring it down, markets are all about confidence, and confidence that we see the plan, we see the balance, we see how we can create equilibrium over time, and that can't be any better.
So it's a tall order, I think everyone would agree to, even as we say we'd love to have it. But right now we have above trend growth. Can we sustain that over the next 2, 3, 4 years? Can we do that?
So I think the harder one is, can you do it without any price pressure? So the U.S. economy, you think about, we've run, I was looking at, almost every single month for the last year, almost the last couple of years, income growth. If you take the payroll and you look at where income is, it's 5% almost every single month. It's amazingly stable. So can we still run at 2, 3% real GDP? If you see some initiatives around deregulation, if you see some initiatives that are incentivize people to invest both globally into the U.S. and domestically, you can still grow. You know, you also have a consumer that doesn't have the leverage you used to have. You have a corporate sector that doesn't have the leverage you used to have. You have a financial community that doesn't have the leverage you used to. So you're in a pretty good spot. It's just the government that has the debt. You have technology, innovation, you have independent energy. U.S. is in a pretty special place relative to the rest of the world. I mean, I'm sure China would love to be in the same scenario. Europe would love to be in the same scenario. U.S. is in a pretty good spot. As long as you keep the engine running and don't have that big tail risk, which I would argue today is the debt's too big, then yes, I think you can keep doing it. It's hard to do over a series of years because the demographic in the U.S. is just okay. But boy, there's enough technology spend, particularly for the next year or so, that could keep the thing going.
So economists tell us that there's a potential for the economy, and it's largely a function of how many workers you've got and how much productivity you have for those workers. Right now, we're talking about, if anything, potentially having fewer workers, the demographics, but also on immigration. So can productivity really kick up that much?
So first of all, I would argue that the best indicator of growth over the intermediate term is demographics. When you track what GDP does, it's amazingly sympathetic to the demographics. Including, like you say, immigration, et cetera, the age dynamics in the country. But that's over the intermediate term. You can come off that demographic curve because of stimulus one way or the other. So think about what's going on. So will you have some modest reversal in immigration? Probably. But I don't think it'll be significant in terms of aggregate demand.
That was BlackRock's Rick Rieder, and David Weston joins us now. So there's risks overall, but it sounds like Rick is pretty bullish here.
No, he's quite bullish. I mean, at the very beginning there, we were seeing a gradual pattern deficit. What he was talking about was his friend Scott Bessent, who's testifying right now in the Senate.
I've heard of him.
And he really thinks there's a way to get the deficit down. And he also thinks that there's going to be different kinds of thinking coming out of this team, including Elon Musk and Vivek Ramaswamy. They're going to think about things differently. Maybe we can get that done. So he actually thinks the deficit's the biggest problem, and they may well be able to address it, and we can keep that growth going.
I'm excited for your inauguration special on Wall Street Week. There's going to be some fascinating people in the audience. I hear Elon Musk, Jeff Bezos, and Mark Zuckerberg are all going to sit right next to each other. There's like $850 billion of combined wealth.
Yeah, and tech bros.
Yeah.
Right? Basically, when you're over tech, that's what President Biden was trying to warn about last night. But actually, Rick went on to talk about productivity and say he thinks that what may be in store because of generative AI and other things is really a dramatic increase in productivity, which, as you know, helps you grow without having inflation. That's sort of the magic thing, because one of the dangers here, of course, is overeating the economy.
Also, the CEO of TikTok will be there as well at the inauguration.
Yes.
So that'll be interesting.
You know, the other thing about this, too, you were talking about Elon Musk, his partner in crime with the Doge initiative here is emerging as a prospect here for a Senate seat.
Vivek Ramaswamy.
Yes, the reason I think this is interesting is because you did have Rick Rieder talking about how you can't really cut all spending in this drastic way for productivity growth, can you?
Well, it's really interesting. We also talked to Maya McGinnis, you know, from the Committee for Responsible Federal Budget, who knows the U.S. budget better than anybody I know. And she was saying, look, there's real things you can do and things like cutting the number of employees, but you cannot get there from here. One of the things I did in preparing for this is realize there's a problem with the federal budget, which is it's not as people intensive as typical corporations are. You got to go after some of those transfer payments if you're going to make real progress on the deficit.
All right, David Weston, really looking forward to that special. Of course, you can catch the inauguration special on Wall Street Week tomorrow at 6 p.m. Eastern. This is Bloomberg.
The normal person you would go to ask about, because this is not so much my portfolio. But
That's Scott Bessent's confirmation hearing for Treasury Secretary underway, and he is testifying before the Senate Finance Committee. Kayleigh Lyons, Bloomberg Balance of Power co-host, is on the scene, really right outside right now. Kayleigh, you know, we know generally what Scott Bessent is going to open with here, but what I'm more wondering about, too, is what kind of questions he's going to get from senators and how deep they may go into certain policymaking aspects of the job ahead for him.
Well, they could go very deep, Sonali, if the opening statements are any indication. We just heard from both the chair of this committee, Mike Crapo, as well as the ranking member, Ron Wyden, both of them focusing in different ways on taxes and tariffs. Specifically on Crapo's part, he said he expects the next Treasury Secretary, in this case would be Scott Bessent, to work with Congress on what he described as pro-growth Republican tax policies. He also talked about trade policy as well and needing to be more competitive with China, whereas Ron Wyden warned of the risk of higher costs for American consumers because of tariffs and talked about how the tax cuts that have been proposed will predominantly go toward wealthy individuals. So that gives you a sense of kind of the partisan line of questioning we could see today. But of course, Scott Bessent will be pleading his own case. He has yet to make his opening statement, but we did see some excerpts of it come out last night, including talking about how the dollar needs to maintain its status as the world's reserve currency, though he didn't necessarily advocate for a stronger or weaker dollar. He could face some questions around that and questions, of course, on his now quasi-famous 3-3-3 policy, where he wants to see GDP growth at 3%, a 3% budget deficit down from 6 and 3 million more barrels a day of crude being pumped in the U.S. He could be asked specifically how he plans to achieve all of those things.
Yeah, I'm glad you brought up the dollar, too. Again, Matt and I were talking about this earlier, stopping short of a strong dollar policy, as you mentioned there. We have also been talking about how this is expected to be pretty bipartisan, that we're probably going to get a lot of attempts at sound bites here. What are you expecting to hear from the Democratic line of questioning?
Well, they're likely going to focus on taxes and tariffs again. If the list in a letter that Elizabeth Warren sent is any indication, it was 31 pages long, and she had more than 180 questions she wanted to ask the Treasury Secretary nominee. She won't have time for that today, as each member only gets 5 minutes, but he might have to submit a lot of those answers in writing. So they are going to get very specific, not just on these kind of wider issues, but on things like the Treasury market, the wider fiscal picture, what issuance is going to look like. He could face questions around sanctions as well as Federal Reserve independence, for example. And I will just say one note on the dollar. As Mr. Bessent was coming in, I yelled at him in the hallway asking if he supports a strong dollar or weaker dollar. He declined to answer that or my question about whether he supports a gradual increase in tariffs. He just said he's looking forward to the hearing today. All that said, this hearing likely isn't going to sway one way or another whether he is going to be confirmed as the Treasury Secretary. He is seen as highly likely to be confirmed. By and large, he is viewed on both sides of the aisle as a well-qualified candidate.
Yeah, it's interesting. We were talking about the fact that Steve Mnuchin went the other direction on the strong dollar policy that Treasury secretaries have supported since the Clinton administration, but only for a moment. Markets freaked out and they backtracked a little. Kayleigh, in terms of the confirmations, how many, or do we expect any to be done by Inauguration Day? I read that there's a lot of paperwork that still needs to be delivered. Of course, we still have to get to the more controversial ones like Tulsi Gabbard and RFK Jr. Mm-hmm.
Yeah, paperwork delays are creating some concern for a few nominees who have yet to have their hearings even scheduled. So without that, they will not be confirmed on Inauguration Day. However, there are some nominees who will likely be confirmed in the early days. Senator Marco Rubio, or at least current senator, who is the Secretary of State designate, had his confirmation hearing yesterday. He is seen as far and away the most likely to go first, as he is likely to get wide bipartisan support from both Republicans and Democrats for that position. We also had Pete Hegseth and Pam Bondi already testifying this week, in addition to many others. So their confirmation votes could come in pretty short order, but it is likely Marco Rubio will be among the first.
All right, Kayleigh, appreciate your reporting as always. Good luck out there. That is Bloomberg's Kayleigh Lines.
Looking forward to balance of power.
Yeah, absolutely. Of course, post-hearing, we have to get through the hearing first. But let's get a quick check on these markets right now. Of course, we're taking a look at light trading and slight declines. The S&P 500 down a hair, but the color is red. Same story, too, if you take a look at the NASDAQ 100. Your biggest weights to the downside right now on the S&P 500, Apple, Tesla, and United Health Group.
Big volume in the Dow Jones Industrial Average.
Oh,
yeah. Up 20% versus the 30-day average.
Trading in the Dow Jones right now.
But, you know, also, when you look at the yield story, interesting. The 2-year hanging out at 4.25, and then that 10-year down at 4.63. Comfortable for the markets.
All right, tomorrow on Open Interest, we're joined by Amy Wu Silverman of RBC and Gabriela Santos of JP Morgan.